Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
Thanks for joining us to take your mind off the regional bank woes for a bit. Those bank worries led to Trend being in the news for all the wrong reasons earlier this week, with huge two-day losses as treasuries had historic two-day moves up, while our friends in the Trend space were massively short, causing -5 to -15% two-day returns for some of the more bigger Trend programs. So how do Trend programs and Trend investors handle this type of action? We're lucky to have Marty Bergin of DUNN Capital on today, taking us through DUNN's nearly 50 years in this game, how their model has changed over the years, what is similar, what's different in this Trend environment, versus the legendary moves in the past years and past decades in this case. This was a fun one. Send it.
This episode is brought to you by RCM and its Guide to Trend Following white paper. How do they do it? Why do they do it? When does it work? When doesn't it? Guide to Trend is a great complement with managers, performance, and more. Ping the team at RCM to dig in. Go to rcmalts/whitepapers to check it out. And now back to the show. All right, Marty, thanks for being here. How are you?
I'm very good. How about yourself?
Good. And tell me about sunny Florida. I grew up just up the road in Vero Beach. You're there in Stewart, right?
Yep. So we're about an hour south of you, and I'm probably 45 minutes north of Palm Beach. Most people are familiar with Palm Beach and Jupiter, maybe not Stewart so much. We're kind of a sleepy suburb of Palm Beach, I would say.
I tell people I grew up in Vero. They're like, where's that? I'm like, between Cape Canaveral and Palm Beach. Yeah. It's pretty
exactly.
pretty big delta there, but
a little larger than Stewart, but I don't think it's any more active than Stewart.
No, yeah. And then I used to love, this was maybe 20 years ago when we first were meeting with you guys, first in the industry, and you had an RV, right? If there was a hurricane and you're all going to load onto the RV and trade from the RV, is that still in play?
No. We actually have another location in Chicago. So that's our disaster recovery location. They're actually in the CME building. So we have a mirrored system that can run from that location. What we used to do is we had agreements with a number of hotels in the state of Florida. So once we determined the track of the hurricane, we would go to another hotel, which they would guarantee that they could provide us high-speed internet. And we would just basically set up in one of their conference rooms, and then we'd have hotel units for everybody in the firm, and they'd bring the family, the kids, the dogs, and it would be quite an experience for 4 or 5 days.
Yeah. I like the RV story better. It'd be like Mad Max, like you're going around Florida, people are trying to get in, you're just doing your trades.
I just don't know how that would work out as far as connectivity.
Right. And then, so speaking of, right, I met you guys first 20 years ago, and you had already been doing it for 20 years. So tell us a little bit about the super long history, how you came to be in the role you're in now, and give us the whole backstory if you could.
Yeah, I'll try, and my pieces along the way. But so Bill was a defense contractor.
Bill Dunn,
Bill Dunn, who was a founder of DUNN Capital. Most people think he was part of the Turtles, but he was not part of the Turtles. He was basically designing and came up with the ideas for these systems in the same time frame, but independently. And of course, he had no idea that other people were doing this. And the story of his first client was they knew that other people were doing it because they had allocated money to other people and they allocated the bill. So they knew more about that it was profitable than he did at the time. But anyhow, back to Bill was in the military, got out of the military, went back to school on a GI Bill and got his PhD in physics. Went to work for a defense contractor there in Washington, D.C. He decided there had to be a better, more honest way of making a living than doing that. So he initially applied the trend following theory to equities. But he came to realize that there was too much data. So there was no way to process and crunch the numbers overnight so that you could trade the whole population of equities the next day.
I've never thought of that, of why did all the initial traders and trend start with futures? Maybe as simple as because they only had to look at 40 markets instead of 4,000.
Well, and in his case, it was only like 12 markets.
Yeah.
We're actually, trading there at the CME that had volume enough to trade. And he started applying to that. And initially, they only ran the program once a week. He was using punch cards in our conference room here in Stewart. We still have like some of the original punch cards in a board.
Nice.
Showing, what the technology was at the time. And he was renting time on a mainframe computer at the local library to, run the system.
I love it.
And was doing it out of his basement. Anyhow, some point he decided that if he was going to make a living at this, which he, quit his day job and he relocated to Florida, wanting to be on the East Coast with the markets, wanting to be in a warm climate and wanting to be close to water.
Yeah.
And I don't know if you know, but the reason he picked Stewart was we have the intercoastal, we have the St. Lucie River, and we have the ocean all come together here in Stewart. So lots of water.
Lots of water. And no taxes. Yeah.
And no taxes. I don't know if that was a consideration at the time, but it proved to be very a good thing.
And what year is this that he heads down to Florida?
That was in 74.
Got it.
It was probably 74 is when he launched. He probably came down here in 78. And we're still he originally started 2 buildings over, then he rented space in the building we are currently, and eventually we bought the building. And this is how we put it as our worldwide headquarters here in Stewart, Florida.
Perfect.
And I was actually working for a CPA firm up in Northern Virginia. The partner in the firm I worked for was Bill's next door neighbor. And when Bill was putting all this together, he went over and talked to his neighbor and said, how do I do the accounting? How do I do all this stuff? So he became Bill's accountant related to all of this stuff. And when I went to work there, the firm was then doing the audits for the funds. And one of the first assignments I was sent on was to go down to Florida to participate in the audit on site.
And had you ever seen futures trades or anything? Was it like looking at Japanese?
I was at the time I was coaching high school football. I had graduated from college with a accounting degree, was studying for the CPA and teaching high school.
Great.
Then I went to work for a CPA firm for 2 years there locally, and then moved into the CPA firm that I eventually became a partner in.
What's your college coaching stats or your high school coaching stats? What's your overall record?
I was an assistant, so I wouldn't say I did coach some. I actually coached a first round NFL draft pick.
Nice.
He
Dan Marino. What was his name?
No, nobody of any knowledge. I did coach some sons of some very famous NFL players. You got to remember, I was in Northern Virginia.
Yeah.
The home of the Redskins.
Right.
I'm sorry, I'm going to have to say the name, but they'll always be the Redskins to me. And I knew Coach Gibbs and Bobby Beathard at the time. So
I was just having that debate with a friend. Sorry, quick sidebar. They were showing Kareem Abdul-Jabbar college stats, and we were arguing like, well, should it be listed as Lou Alcindor, right? Like, right? He got those stats under that name, not under the change name. So same thing. Like, hey, you're this at the time they were named the Redskins, so use the name Redskins.
Well, and I will say he's the same person. They're still the same team.
Yeah,
they aren't any good anymore.
That's all right.
I digress. Anyhow, I had become a partner in '97 of the firm, at which point Bill contacted me and he said, if I'm interested in hiring somebody from your firm, my understanding is I need to check it out with you first. And I said, well, that's a common courtesy, but you don't need to check it out with me. You know, I'd be honored if you wanted to hire anybody from my firm. Are
And he
you
said, what about you? Yeah.
well, and that's exactly right. What I didn't know is Bill had contacted the firm in the past because he wanted to hire me. And the firm basically said, no, we got plans for this guy. You know, we're going to keep him. Then he contacted me. He said, well, I'd like to hire you. And I said, well, I got a pretty good gig here. You know, I'm a partner in a CPA firm doing well. Family is all here. My life is all here. His next comment, I'll never forget. He goes, well, that's okay. I'm not even sure you could really handle it. But why don't you come down?
The takeaway, right?
Yeah. I said, he said, why don't you come down and just meet everybody and see what you think? I go, Bill, I've met everybody. I've been coming down there twice a year for years. I think I know everything that's going on. Just come down anyhow. Anyhow, long story short, it took me about 2 seconds to say yes. And, you know, at DUNN, everybody wears multiple hats. We got a small firm, and you basically come in here and figure out how you can provide value to DUNN. And assuming you do provide value, then you can basically write your own script of how it'll go through the year. So, you know, I did everything from working night shift on the trading desk, doing tax returns, stuffing statements. You know, I've done everything and anything that you could basically do in this industry down here. And eventually, you know, we had to come up with some kind of plan to continue the firm. You know, most of the firms that were started in that day and age, they had very strong personalities, the founders of these firms.
Yeah.
I mean, Bill is no exception. I mean, if you've ever met Bill, you would actually, you're totally mesmerized by the man. He's extremely intimidating. He's got a handshake that'll bring you to your knees. It's like a bear grabbing onto your hand, but you have this instant comfort and confidence in the guy that you just can't get over. It just doesn't happen with other people, but with him, it's that way. Anyhow, so we came up with a transitional plan where it was supposed to be a 10-year process of me taking over the firm. He would stay, making sure everything, you know, went smoothly. I always viewed Bill as a mentor, so it was kind of a natural fit.
Yeah.
And then 5 years into it, he accelerated the plan. Thought things were going well. What we didn't know at the time was he had diagnosed that there was something not right with him. And he actually went and got tested, and it determined that he had early onset Alzheimer's, which he knew about it before we did and didn't come clean about it until, you know, after we accelerated things and transitioned through. And it's worked great. Everything's gone well. He's living on the West Coast now with his wife, and, you know, he's got some caregivers that come in to help with things, and he's physically still just a, you know, strong individual man, but he just doesn't have communicative skills at this point.
Oh, that's a shame.
But he's 89 years old.
Yeah, he put in a good run.
Yeah, he's had a great run, and he's happy. You know, you hear about some Alzheimer's patients that can kind of act out with anger and have different spurts of personality, but he's just a very happy guy, and smiles, and, you know, still wants to shake your hand, and, you know.
And it testament to the systematic nature too of, right, he's out and the program keeps running, right? So it's not,
yeah, everybody
was
always asks, well, what's the next process for you when, you know, you step aside? And I think it doesn't really matter.
Yeah.
The system's going to run with or without me, or with or without anybody here, as long as there's people there to push the keys on the computer when the time comes that needs to be done. The other thing about the systematic nature, which is very timely right now, is given what's going on in the markets, with the bank failure and things of that nature, emotions really want to take over.
Yeah. Let's protect.
And it's kind of nice to know, even if it's bad or positive, that I'm not having to make the decision here. The computer is basically dictating what we do. And we have some testing behind us. We got over 45 years back there. And so we know that the system will adjust. The system will, take care of whatever losses are occurring now, and we'll turn it around and eventually make back those losses and get to new highs.
And talk through this. So is that the first trades for clients were 45 years ago?
Yeah.
Wow.
Yeah.
Right.
Over 45 years ago.
Right. That's got to be one of the longest track records.
I think it's 50 years next year.
Wow.
Yeah.
That's right. If not the longest, right up there in the running for.
Absolutely. Absolutely. And at one time, John Henry and Bill Dunn were the two largest CTAs in the world.
Yeah.
That was a long time ago. And now we're way down the list, but that's okay
Right.
for us.
But that seems like that was sort of by choice, right? It seemed like at the time, and maybe it wasn't a conscious choice, but like, hey, we just do what we do. We're not trying to institutionalize and go after all this pension money and all this big, right? All that, even not to say you're not institutionalized, but there's kind of two paths of like, hey, we're just going to run what we run. And we're going to polish everything and make sure we can get everybody's boxes checked. And
right. So I look at it as you're either an asset gatherer or you're a moneymaker.
Yeah.
So, our goal is to continue to make outsized returns because we don't charge management fees. So there's no reason for me to gather assets just so I can collect an asset-based fee. So what I've seen in the industry, especially over the last 30 years, 25 years easily, is the industry has become less volatile. So everybody's dialing down their volatility because they don't want to have bad results, right? Investors remember the bad stuff.
Yeah.
They remember the outsized losses. They don't remember that you recoup that and you got to new highs over and over and over. So to offset that, people tend to lower their volatility so they reduce the downside volatility. We've tried to do that, but I don't want to give away the upside. So we came up with this adaptive risk profile, which we instituted in 2013, where instead of targeting in the industry, when the beginning of trend following, let's go back a little bit farther. In the beginning of trend following, everybody always set a risk target, either volatility or VAR, and it's always the same all the time. And you just adjust to get back to that risk target. And in the beginning, you didn't even vol adjust. So you set up a risk target that was look back over 10 years. And then the risk would actually change with the volatility of the markets. The idea being, as the market becomes more volatile, more trends come into play, and you tend to be making more money. So you want to have more risk on at that period of time. So this is like Jerry Parker at Chesapeake. There's nothing wrong. I mean, I hate it when people say, oh, that's not the way to do it in this day and age. You got to vol adjust your performance. Well,
says who? Yeah.
There's two different ways to do it. You could either vol adjust or you don't have to vol adjust. And both of them are acceptable. And I understand the argument for both. Now, we do vol adjust. But we felt like we had to because that's what investors were looking for. So it really cut down on your population that's going to invest with you if you're not going to be more institutional in that way.
Yeah.
What we did to offset that was instead of having a steady target, a risk target, and adjusting to it every day, we now adjust the targeted risk based on the market conditions. So it's almost like a counter to vol adjusting, where if the market's trending And we have a systematic proprietary way of measuring the market environment and then determining how our portfolio lines up to that environment. And if it's a positive environment, we increase the risk slightly. And it's not risk on, risk off. It's not, we aren't throwing a switch.
Right.
But it's a small adjustment that occurs each day, several basis points. Sometimes it might be 10 basis points, but most of the time it's 1 or 2 basis points. And you're either increasing the risk in a good market environment and you're decreasing the risk in a bad market environment. And so what this does,
And
where
just
it came into play for us,
so for clarity, good and bad meaning trending or not trending.
Trending or not trending, exactly.
Yeah.
So when I say good or bad in our view of the world.
Yes, exactly. Other people are like, you mean an up market? No, not necessarily. Yeah.
So where this really came into play from us, or what brought the idea to us, is when you started getting into the zero interest rate environment and there's no volatility, everything's sitting at zero. But what trend followers were doing that are vol adjusting, they're loading up on those short-term markets, short-term interest markets. And you're looking at that, go, why in the world are doing this? And that's where we came up with this idea that, environmentally, we know when it's a trending market, we know when it isn't. We got things we could calculate to determine that. And then we can adjust what we really want to do risk-wise, given those environments.
And that's on a per market basis?
Well, it's on a portfolio-wide basis. That is, then everything we try to do is we try to keep everything in as robust as possible.
Mm-hmm.
So everything we look at, we do as a portfolio as a whole. Of course, everything gets dictated down to the individual market levels. So whatever adjustment you make for the portfolio has to be encompassed in everything.
Right. So you're not looking at corn and like, hey, corn's super trending right now. We're going to increase the risk budget in corn.
No. So the way
which I've seen that done with mixed results in the past.
Absolutely. So
mostly on
that's kind of handled by the strength in a market. If the market's really trending, you're going to get a higher strength in that market than you would in another market. And the other thing we do is we don't tailor anything in the system to markets. We use the same, whatever we come up with, every market is trading the same parameters, the same methodology, the same everything. That way we're trying to prevent ourselves from getting in a data mining situation where you fool yourself. I mean, so think about it. Everything we ever look at when somebody brings us an idea or brings us a system is it data mined or not? In 98% of the time, it's absolutely data mined.
Yeah.
But how do you avoid that? And because the lion's share of the money is ours, everybody that works here has the significant amount of their net worth is in the funds. And we're trading exactly the same system that our investors are trading. So it's not in our best interest to fool ourselves. We want to be as robust as possible and make sure we haven't data mined the system.
And
but
so
back to the adaptive risk, the only other thing I wanted to bring in, by doing this, what we found is we were able to decrease the downside volatility by about 25% without giving away the upside. Actually, the upside is a little bit enhanced because you don't go down as far each time when you have the recovery.
Right.
So
and that's always the trick, right? If you hear vol targeting, my brain immediately goes to like upside capping. Like they're kind of the same, one and the same thing. So that's the trick. How do I keep that classic trend following, right? That Dunn made his name on, right? Of like, hey, when these outlier moves happen, I knew I saw silver rallying, whatever, back in 01 or something. I knew if I pulled up the results that Dunn was going to be at one of the top of the tables in terms of like capturing that upside.
Yeah.
I think over time we saw, was some downside in there. I actually...
Absolutely.
Yeah. And I actually, this was way early in my career. I remember looking at your track record, like who would still be in that after this big drawdown, right? And you guys still had a 800 million or $1 billion or something at the time. I'm like, who is still in there? And then someone's like, it's all their own money. It's made right.
Yeah.
If you put in 100K and they ran it up to $1 million, and you go from 1 million back down to 600K, like you're still up 6x and quite happy. So whatever, you don't care about those drawdowns as much as if you started from scratch.
Well, and so that's the problem with 2007, 2008 scenario, right? When
Yep.
all the trim followers made a ton of money. Nobody was allocating the trim followers prior to that. Now all of a sudden they see, oh, maybe these guys have a place. So they all pile in there at the top. And then you have mediocre performance for a while. And I'm not, people talk about the lost decade of trim following. I don't believe that. I mean, we made good money during that time frame, but we weren't as good as the S&P maybe.
Yeah,
We
exactly.
were about to say. So and people are like, well, this isn't doing what I wanted. I could have just left my money in equities. Why am I doing this? So they get out again. They have a bad experience because they bought at the high. They get out at the time when they're disappointed. So they go away mad. And then we have what happened last year, which I will say kind of started in 2021 through 2022, the inflationary trade. And now people see the value again. The difference is what I'm seeing now is if we have a bad month, like January, for instance, where the industry as a whole didn't, but we did, we had a bad month. All of a sudden I'm seeing money coming in, which
Right.
never used to be that way in the past. It was always, you have a bad period, man, money's going out the door.
Yeah.
So that's been a little pleasant experience that maybe people are starting to understand where the value is in this. And what I keep telling people is you've gone through this inflationary trade period. It's going to switch from inflation to recession. So there's going to be a lot of money to be made in the recession trade. There's going to be a lot of money to be made in the inflation trade. But that transitional period in between is going to be hard. It's going to be tough on trim followers because they're two opposite trades.
And you won't know when the one necessarily ends and when the one begins. If you knew that, you'd just turn the switch.
And from experience, what I've seen is when you go into these recessionary periods, there's usually like 3 shoes that drop. And the third one is the real one.
Yeah.
The first 2 are kind of the head fakes.
I want to know who you're hanging out with that has 3 shoes, 3 legs. But and part of me wants to say those people just missed their like end of year rebalance and we're putting their money in based off the 22 returns and we're just a month late. I don't know if their behavior's changed.
Well, we'll see what happens after this month because this bank implosion issue, this may be the tipping point to go into a recession.
Yeah.
Or it could be like the early 70s when I don't remember who the Fed chairman was that was there before Volcker, but I'm old enough that I was around. They took their foot off the accelerator. They took a pause there early on because the economy was faltering, and that's what really set the inflationary or stagflation into existence and pushed it up to where Volcker had to get to somewhere in the mid-teens on short-term rates to get it under control. We could be looking at this same thing again. I mean, Powell is sitting there now trying to decide, does he pause?
Yeah.
Or does he go in at 0.5%? And right now you're seeing bonds rallying like crazy over the last 2 days.
Crazy. I mean, it's in the 99.9th percentile of 2-day moves.
And has anything changed in the world of inflation? I suspect not. I mean, they're talking about bailing out banks.
Yeah.
Which is extraordinarily inflationary. So it's going to be interesting. It's going to be very interesting.
So talk a little bit about you're back in this tracker back into the 70s. There's been plenty of great years like 22, what have you seen in terms of the similarities in terms of like, were they all, for example, 10-year notes drove the profits in 90% of those, or right? Is there any similarities between all those good years in terms of which markets were moving? And then any similarities and differences in terms of like how much the trends were?
I would say that we're a little bit better at capturing a longer duration of the trend today than what we were back then. I mean, you got to remember 95 was probably a better year. But the markets were different then. The system was different then. You weren't trading financials. It was more commodity based back in that day. So what I will say is, in every one of these environments where you're making a lot of money, you could point to one or two sectors that drove the performance. A lot of times it's energy, because that's one of the most volatile markets, and because of the world economies of things, that's the market that tends to be involved in every one of these outside returns. Then you get some currency stuff. And sometimes you get geographical. Like I can remember years where we made a ton of money back in the late 90s, early 2000s, driven off everything that was in Asia. JGBs, topics, Osaka, Japanese yen, all trended and all made huge amounts of money.
That was like the Asian debt crisis, like 90,
yeah,
whatever
exactly.
it was, 94-ish.
Exactly.
Yeah. Which is odd for you to say that, because I think most, whatever you want to call them, analysts or people like me would say, especially detractors would say like, oh, they just generate all their, not you in particular, but trend followers, right? 90% of the returns come from interest rates and bonds.
Well, but you know why that is? Because that's the largest number of markets that we all trade. So
right. The most liquid, the most you can access with billions of dollars.
Absolutely. Yeah. So, we allocate the equal amount of risk to every single market we trade. So if you add it up, the number of interest rates we trade is in relation to everything else. It's the largest percentage that we trade. So that sector is going to probably most of the time make more or lose more than the other sectors.
Right. But that kind of begs the question, and like looking at these last 2 days, like, can you have too much bond exposure at the cost of proper diversification, right? If it's worked over these last 35 years, is it going to work over the next 20?
No,
especially if we have rates gradually or generally rising over that period.
Well, so I would say the interest rate environment probably drives 90% of all the other markets. I mean, it's definitely influences the currency market. It's definitely going to influence all the commodities, because all the commodities are priced in US dollars. So the interest rates there influence the US dollar, that influences all this. So, I mean, we're always looking at the cross-market correlation of everything we trade. So the more markets that are like as interest rates are, the higher that correlation is going to be. Therefore, the less risk we're going to have on for the portfolio as a total. And one of the things we've done recently is we're trying to, when we add a new market, for instance, we look for markets that are uncorrelated to what the portfolio is. So we're less likely to add another bond market than we are to add another metal or add another ag of some type, usually with some kind of geographical diversification, because that's what brings in. I mean, we're only looking at the numbers. What would make something more diversified than what we currently have?
And how many markets are in the portfolio now? You mentioned back in the day, Bill had 12. Did you say?
Yeah, and now we're up over 55.
Yeah,
and I mean, I think we just added a market last week. Iron ore or ferrous metals. We'll probably add canola this week. I mean, we're looking at adding some markets because we know that diversity helps our performance. But here's an interesting one. Do you remember back when Oh gosh, it was probably right after the financial crisis where everybody was talking about, oh, the only reason CTAs make money is because of the carry
Yeah.
in the
Yeah.
interest markets, right?
Right. Because
It
they're
was
holding T-bills.
constantly.
Yeah.
And so you can't make money at
Back that
zero
out of their
interest rates. You
performance.
can't-
Yeah.
And that the CTAs never get short bonds.
Yeah.
Well, I mean, you had a 40-year bull market in interest rates. You know, we're probably going into a prolonged bear market in interest rates that, CTA should do just fine on.
Yeah. But Roy Niederhofer has a paper out that's like 6 years old now, I think, but right, showing that it's not going to be a mirror image
No,
because you do have to pay that carry.
there is a carry.
Being
And if the
short
interest
bonds.
rates get high enough, you're not going to be a short if you get short. And at some point, you're going to get long, but the long is going to be much less. I mean, you're going to make money on that roll yield. So,
Yeah. Right. But yeah, I think that's important for people. Yeah, even if it's it was a tailwind this whole time, that doesn't necessarily mean it's going to be a headwind moving forward.
exactly.
Yeah.
Exactly.
It doesn't mean the flip side is going to be totally true. That it's going to be an equal tailwind, just now you're short instead of long. But so you talked a little bit about the we were talking about the markets, all these good years followed by, you mentioned it briefly, some bad years following the good years. Do you think investors, what have you seen over the years in terms of these investors of like,
It's funny you ask because the question was put to us by one of our larger investors. You had a great year. What is the expectation? You got to have a bad year, right, to bring it back down.
Yeah, right. So you don't average 80% a year, right?
Yeah, reversion to the mean, and what we've seen is there's no correlation from one year to the next. In Trimby, I would have expected to see a little autocorrelation. The
Yeah.
one thing we do see, because if the assumption is that you've made money over the long term, so there's one thing that if you had a bad year, there's no way you could consistently be making new highs. If you had a bad year, the next year is going to be good, because otherwise you would have never made it to new highs. So if the assumption is that the line is going up the chart, you're rising up the chart, then a bad year has got to be followed by, something better.
Right.
If your performance had been that it was going down all the way across, then a good year would definitely be followed by a bad year. So there's no way to get back to that performance level without that happening.
I think that's what drives a lot of investors crazy about trend following, right? More technically speaking, there's not a high persistence of returns, right? Yeah. So they're used to other markets where, a good quarter is followed by another good quarter by another one until there's a sharp drop.
Because it's driven by something like a great management team or a great product or a great technology. This is just price data that's being analyzed for trends. And we're not trying to predict the future. We're not dictating what's going to happen next. We're just following along, which is another thing that investors can't understand. If you're doing trend following, you have to be willing to accept losses. It doesn't work unless you're willing to absorb losses, because there has to be a point in time. If every time the price moved against you, you got out of the trend, you'd never get the trend.
Right.
So you have to be willing to accept a certain amount of reversal before you exit the trade. And that, by definition, is trend following. And if you're not willing, if you can't stomach those bad performance periods, then you shouldn't be investing.
Right. And but you have hundreds of billions that are going the opposite way of like, no, we can create a better mousetrap. We can go shorter term trends. We can add mean reversion. We can add.
Yep. So what happened there? You had a number of people in the industry. I mean, a lot of people I'm competing with, that during this period after the financial crisis, I'm looking at their numbers. I know that something's changed.
Right.
And I look at markets where they're making money and I'm saying, wait a minute, you're not trend following if you're making money here. And all of a sudden, no drawdowns, blah, blah, blah. Now we get into a year like 22, they make 10 or 12%.
Yeah.
I'm like, what's that about? I mean,
Right.
that's not trend following. If you made 10 or 12% this year, you were not doing trend following. I mean,
But that's an interesting philosophical. Were the investors happier, right? If you had less drawdown back then and then just a small gain when trend killed it, is
well,
that
exactly right.
institutional investor happier?
So now you're talking about multi-strategy, which I'm
Yeah.
not saying there isn't a place for.
Yeah.
I trade one internally that we're in the process of developing that we will eventually come out with. And I think there's a real value in that. But don't tell people you're a trend follower.
Yeah. Exactly.
And,
Don't put trend following on the cover.
I mean, there's one particular, competitor out there that was knocking the ball out of the park.
Yeah.
And all of a sudden, they're down huge over the last 2 years because of reality, they're running global macro. They're not running trend following.
Yeah.
But they portrayed themselves as a trend follower and they have great credentials, but it kind of leaves it's bad for the industry because those people that invested with them are not going to want to go out and get another trend follower because they think this is what could happen.
Yeah. And then I'll extend that even a step further. If people invest in managed futures, right, which could be a discretionary ag trader or an energy trader or whatever, that didn't have the great last year. And then they say, oh yeah, I tried that, but the trend follower I got into didn't even have a good year last year.
Yeah.
Like, well, no, you were in a managed futures program that wasn't a trend follower. Maybe they're short options or who knows what they're doing, but there's a lot under different. Yeah, there's a lot under that managed futures umbrella, which isn't necessarily trend.
Yeah. It's but so one of the things I do here is if anybody invests in one of our funds that we run internally, they can't invest until they have a conversation with me. At which point I basically point out all the things that can go wrong and make sure that they're comfortable, and I have to make the decision if I'm going to let them invest.
Right.
So it's not their decision, it's my decision, and then they have the final decision if they want to actually do it or not. And there's been people that after that conversation, they say, let me think about it, I'll call you back, and I never hear from them again.
Right. Which is fine. You did your job, they did their job. Everyone was comfortable.
But what's great about it is when things aren't going well, I'm not getting phone calls saying what's going on. I thought this always made money.
Right. Yeah. You promised this. I didn't promise anything.
There's no promises.
And I would say, do you think at some points the long track record has actually been a hindrance to raising money and getting new investors? Because all your warts are there to see for the world, right? 40 years of warts, whereas the new young model comes out and like, hey, no warts here.
So this is one of my gripes. So, I have one of the largest drawdowns for the longest period of time in our track record. Most firms, when they go through a bad period like that, they relaunch a different strategy under a different name and start over again, right?
Right.
Well, guess what I have that they don't have now? I have a track record that's going to be moving in on, 40 plus years, 50 years. They don't. Now, all the bad stuff is there, but the farther you get away from the bad stuff, the less people tend to focus on it.
Yeah.
But they can never say that they didn't know.
Right. But I see it all the time, right? Like, and statistically, right, if you wanted to create a really high Sharpe ratio program, right, you'd go all negative skew, maybe some option selling, right, which is going to have this perfectly consistent gains until it doesn't. But in the meantime, you're going to have this super high Sharpe. So to look at a program like yours, like, oh, I don't like the MAR ratio because of that big drawdown. I don't like the Sharpe because of it, right? And we haven't even gotten into that. The Sharpe's going to penalize you for these big upsides over the track record too. So whatever, we're preaching to each other's choirs here, but it's just an odd, you'd think in a perfect world, in a vacuum, investors be like, I want the program with the best long-term track record. I want to see as long as possible. But I think most investors will fool themselves. They're like, well, I just want to look at the last 5 years. I want to look at, doesn't matter to me that they've had 40 years of innovation, right? That's really what it is. Of like, forget the numbers and performance. It's a track record of 40 years of innovation.
Yeah. So think about when Bill started DUNN Capital, there wasn't even a regulatory body in place. And that's how long ago it was.
Yeah.
They didn't even have a regulator for this product. And Bill was actually instrumental in the whole idea of having the NFA, a self-governing body that then reported to a government. And they didn't report to the SEC back then. They reported to, I have no idea, but another branch of the government. And everything went pretty damn smoothly over the years.
So I bet we actually had a broker that worked for us once that predated the NFA, and it was a hassle because we had to send them. She had some little pink card or something from whatever, and we had to send that to the NFA and be like, no, she was registered with whatever was before you.
Yep.
So it was a big hassle.
Bill never took the Series 3. He was grandfathered in. He was around before they had a Series 3.
I love it.
It was great.
You can't argue he didn't know what he was doing. I'm going to come back a little bit to the or I was just had a comment on the vol targeting before. Do you think that's and back to, I want to blame all you nasty investors that are listening. Do you think that's right? It's their own fault, right? They've demanded the lower volatility and the managers have come up to meet them where they want.
Yes.
So to me, like they're like, oh, we'd wish it was lower volatility. Then everyone lowers it. And now they complain that the volatility is too low.
Well,
it's like a chicken or an egg. Yeah.
I don't know how many, I don't hear people complaining about it. But I think people are becoming more educated about it because the one thing they're starting to realize is the reason you want to allocate to managed futures is the non-correlation. So by adding the managed futures volatility to your portfolio, you actually reduce your overall volatility.
Yeah.
So if you go into a low volatility manager, it just means you have to move a lot more assets to that manager that gets the same bang for the buck. What we're finding is people like our volatility and some of the higher volatility of other managers.
Yeah, it's capital efficient. Yeah.
Exactly. I mean, all I have to do is move over a little bit and I get a really good bang for my buck when I need it, right? So 2022, when everything else, my bonds are down 20%, my stocks are down over 20%. But guess what? I had DUNN, who was up over 60%, or I had Mulvaney, who was up over 100%, because, I got more bang for my buck there. Of course, the reverse can happen too.
Yeah.
Your stocks are doing great and, we're in a drawdown. And Mulvaney's drawdown is going to be worse than mine just because the systems are designed that way.
Right. A little higher octane.
And I'm going to be worse than some of the other people out there.
There was a great chart, I think it was Welton years ago, of saying how much do you need to allocate and per the vol and everything. And there was like basically the allocations most investors have to trend. It's like 5%, 5 to 20%. Like the returns you need at 5% to make a difference are like 200% a year or something.
Yeah.
So they're way underinvested even at a high vol level. So if you're picking a low vol manager, you're insanely underinvested to get those benefits.
So here's the other thing we find is most people look at it as a percentage of their AUM. And what we try to explain to them, no, it's a percentage of your risk you need to allocate. So we know by stats that statistically, the efficient frontier would be 20 to 25% of your risk allocated to a trend follower. Now, you could get that one or two ways. You could go into a low vol manager and allocate 30% of your assets, or you can go into somebody like me and allocate 10 to 15% of your assets. And you get that same risk allocation. And what I find now is more and more people seem to want to come into our fund, and our fund gives them an option of levering a little bit. And they all want to take the leverage.
Yeah.
Because, hey, I'm doing this because I want the volatility. So give me more volatility.
Although in my experience, they want that and they do that. And then when the bad volatility comes, they don't quite understand that downside.
Well, that's why they have the conversation with me.
Good. You have to explain it well.
Yeah.
A bit of a finer point, but we were talking off screen a little bit about some of these newer replication products. And so like I could go to a bank and get one of their risk premia and get the trend risk premia, right? So what are your thoughts? Been doing this so long and creating this portfolio, like, okay, I can replicate what Dunn's doing at this vol with these 12 markets.
Yeah. So I'm kind of, I don't pay attention a lot of what's going on out there.
Yeah, and ignore anyone who's actually doing it. But like, if I just said, I'm going to try and replicate what you're doing, Marty, and yeah.
So I wasn't even aware this was going on until somebody brought it to my attention. And in doing so, they sent me the materials for this ETF. And I started looking through the materials and stuff. First off, it's an ETF, so it's not governed by the NFA. I don't know who looks over the marketing doc. I assume the SEC, and they get a lot more leeway, evidently, in marketing documents than you get with the NFA. But first off, everything they presented is simulated numbers. Nothing's real. And which means that it's all been back tested. So they basically took a data stream and said, okay, what do we have to do with the markets to get this same performance over the same period of time? We want it to be 90% correlated. So they come up with, I mean, it's not that
like
hard.
The definition of replication. Like basically I need to copy this index with some other products. Yeah.
Which is real easy historically.
Yeah.
Not so much live going forward in real life. So there's two things that are going to happen. One is it's all going to go just fine when the markets are behaving as expected. Your routine market environment. They will probably be able to pull this off. To a certain degree, there will be a little bit of divergence from time to time, but they'll probably be able to pull it back in.
Well, to our point earlier, if you, besides these guys who mistakenly had trend on the book, cover their book, if you were anywhere near trend, we're in some range up here.
Right.
Like it was pretty easy with any sort of trend following model to make money last year.
Exactly. And trend following is not rocket science.
Yeah.
But to do it with just a few markets as opposed to the whole gambit, the reason you have this diversified is to control the risk. And so I think what's going to happen is when something unusual happens or environment like the last 2 days, today and Friday, it'll be really interesting to see how those funds do in that market environment.
Yeah.
Because with 12 markets, it's a lot harder to control the risk as it is with others. And I would imagine that those 12 markets are going to be very, very large, very, very liquid markets. One of those markets moves against you in an excessive way. That could be a real interesting situation.
But I think that my counter would be like, all right, cool. You guys added iron ore. It rallies 600%. Maybe it gives 60 bips to your yearly performance, right? So that would be my counter of like, yeah, you have all these diversifiers, but what do they really do in the grand scheme of things?
Yeah, I think it helps you more on the downside.
Okay, right. So
that's what I think
you're adding maybe that 60 bips took away from this 6% loss on the year and get 10 of those. I
had allocations to everything else that got reduced to do that allocation to that market. So the exposure is more balanced than if you have 12 markets, the exposure is going to be very intense in each given market.
And especially if some of those get, right, if you have a bank running one of these that has a couple $100 billion in it or something, like in one of those markets and they need to get out, that causes its own problem.
Well, yeah, I'm assuming that they're only trading the markets that have the highest volume, and they must have some kind of caps in place of how much of the market they'll be representing. And I know that we, have very hard caps about we won't be any more than a certain size of any particular market.
And what's your thoughts on that size overall, right? Over your 30 plus years, you've probably heard a lot of times trend following's too big. That's why it doesn't work anymore.
Well, I think what's happened is trend following has changed the way operationally we work because of that exact problem. So in the early days, you traded the whole position at any given time. So if you were long the whole gambit. And then one day you came in and you decided, I want to be
Getting
short,
out. Yeah.
and you traded the whole thing. So back in the 80s, well, even when I came here in 97, I can remember getting calls from the Wall Street Journal saying, we understand that a large hedge fund in South Florida was trading the 10-year. Was that you? And no comment.
Yeah.
But it was. I mean, we were 70 to 80% of the volume in one day in an interest rate market. I mean, that's huge.
Huge. And
That
were you
can't
worried?
happen today.
Yeah. Were you worried at the time of like the floor traders knew it was you placing the order and some of the locals got in front of it? And
Oh, there's no question, but that's
Yeah.
just the price of doing business.
right.
And guess what? All the traders love you.
Yeah, exactly. Like,
Because, they see you coming and, they make money off of that.
and what are your thoughts on over the years, whether it's become harder because of all the computerization and automated orders routing and prop firms doing scalping, right? Basically, once the floor went away, it's become harder or easier or no difference to you guys?
It's different.
Yeah.
It's better in a number of ways. I think it's a little more frustrating in some ways. I mean, so you had the floor traders that were robbing you before. Now you got the high frequency guys that are robbing.
You now.
So, I mean, there's a reason why Ken makes
Yeah.
so much money every day, because he's the market maker and he's going to get paid for doing that.
Yeah. And for sure, someone inside there is running a model that they believe represents, right?
Oh, absolutely.
85% of the flow of all the trend following space.
And they see all the data, so it's not hard for them to come up with that.
Yeah.
And, they can modify and adjust as needed.
What's the future look like for trend? Bright?
Well, I think what I was talking to you about earlier was, you have this market environment where we've made a lot of money in what I would call the inflationary environment. And at some point, it's going to switch over to a recessionary environment, which will also be great for trend following. Don't get me wrong, it's going to be outstanding. But getting from the inflationary trade to the recessionary trade is going to be a difficult environment for trend followers. And like what's happened with this bank situation, that could be a head fake to a recession, or it could be the first step into a recession, and nobody knows that for another couple weeks, right? Or
Yeah.
it might take a couple months. And what is trend following going to do in that meantime? I mean, right now, I would love it to just kick right back into the inflationary environment and
Not have to get out of those short bonds. Yeah.
right. And the market movements that we're seeing right now is most trend followers are definitely going to be reducing that exposure.
Which we
The
argue
short
it's maybe
bond.
part of the rally in bonds past few days is them reducing that exposure, buying them back.
Exactly. I mean, the trend followers are pushing this market now. There's no
Yeah.
question about it. So, but it's also people that have fear and are buying into the bond market and getting out of equities because of fear of recession. That's
Yeah.
also driving it. So there's a lot of forces driving the interest rates down right now. And if inflation is truly here still, which there definitely wasn't anything in that employment report to tell you inflation was over. We're going to get some numbers out this week, which it's funny that I could care less. I mean, numbers mean nothing to me because the system will dictate. It's all based on price. But for the first time, I'm actually interested to see what the inflationary numbers this week come out as.
Yeah. And just personally, there's everywhere you look, prices are going up. There's no,
Yeah.
I don't see anything slowing down. We were at the conference in Miami. That place was rocking. Like nobody was worried about spending or pulling back. So
I mean, restaurants are just ridiculous what it costs to go out for dinner.
yeah.
And
Yeah.
yet, I don't know what it's like where you are, but in Florida, everything is packed. I mean, you cannot get in a restaurant without a reservation, and you have to look weeks in advance to get them.
Yeah. Same.
So they need to start a policy down here that, locals always get a table, and the snowbirds are the ones that don't get tables.
When you're pulling into the Orlando airport, if you go off to the right, whatever that road's called, and there's a gas station there, I'm filling up the rental car. It says like, this was years ago, like $275 on the sign, filling it up. And the price was enormous. And it ended up, they charge $575 if you don't have a Florida license, or if you don't enter your Florida zip code when you put the thing.
That's amazing.
Yeah. So I started arguing and I'm like, I grew up in Florida, and I'm like, over the little speaker thing, I'm hitting the button, arguing with the guy, and he's like, whatever, get out of here. I'm like, all right, I'm going to miss my flight, but
that's why we have flyers on the windows.
Yeah, exactly. Well, thanks, Marty. This has been fun. We'll come visit you down there in Stewart next time I'm in Vero.
Perfect. More than
Yeah.
welcome.
We'll get it done.
The worldwide headquarters of DUNN Capital.
Yeah, tell everyone where they can find you. What's the website?
It's just Google DUNN Capital.
It works.
Yeah.
Awesome. Thanks so much. Best of luck with everything. We'll talk to you soon.
All right. Take care.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.